What if I told you the ultimate speed limit on the artificial intelligence revolution won't actually be set by tech giants out in Silicon Valley,
Right.
or even by government regulators for that matter, but rather by a group of quiet actuaries sitting in a commercial insurance office?
It sounds kind of crazy when you put it like that.
It really does.
Yeah.
But welcome to the deep dive. Today, we are attempting to sort of reverse engineer one of the most fascinating mechanisms in modern finance.
Yeah, we're looking at the Q1 2026 financial results of W.R. Berkley Corporation.
Exactly. Which is one of the largest commercial lines writers in the U.S. They were founded back in 1967.
And they insure some seriously complex stuff.
You do. But, I mean, before we could even get our hands on the stack of sources for today's analysis, we ran into a little hurdle. It perfectly encapsulates the weird, automated world we are living in right now.
Oh, the security check.
Yes. I literally had to prove to MarketBeat.com's Cloudflare security that I was, in fact, a human being.
Just to get to the financial PDFs.
Right. I actually wrote down the success code just to commemorate the absurdity of it. It was Ray ID 9S055CH4F29. Like, I am flesh and blood. Please let me read this data.
Which is honestly incredibly fitting. I mean, we are looking at a company whose entire business model revolves around calculating and navigating risk.
In a world that feels increasingly unpredictable.
Exactly. You had to pass an automated security checkpoint just to read about how an insurance conglomerate is, pricing the risk of those exact same automated systems failing.
That intersection of chaos and calculation is basically our mission today, because insurance often feels like an absolute black box from the outside.
You just pay your premiums and hope for the best.
You pay the premiums, you cross your fingers that your warehouse doesn't burn down, or that a cyber attack doesn't freeze your servers, and if it does, you just really hope the policy pays out.
Yeah.
So our goal for you, listening right now, is to pry that box open. We want to extract the so whats from these dense earnings reports.
How does a holding company look at a highly volatile global landscape and manage to deliver these historic profits?
And maybe more importantly, what can their specific strategy teach you about balancing risk, safety, and reward in your own career or business? Okay, let's unpack this.
So the scale of what they achieved in the first quarter of 2026, which ended March 31st, it requires a bit of context to fully appreciate.
Right.
When you pull back and look at the top line numbers, we are not just seeing incremental growth. We are looking at a fundamental outperformance of their own historical benchmark.
The numbers practically jump off the page. I mean, net income saw a massive 23.4% growth.
Which is huge.
Hitting $515.2 million for the quarter. If you break that down, it's $1.31 per share. On top of that, their operating income hit an all-time record of $514.3 million.
But all of that pales in comparison to the ROE.
Yes, that was the metric that actually stopped me in my tracks. The absolute standout number in this entire stack of documents is their return on equity, or ROE. They hit 21.2%.
Which is wild.
Right. W.R. Berkley has a stated long-term target of hitting a 15% ROE, and that is already a deeply respectable, aggressive goal in the insurance industry. To land at 21.2% is just staggering.
It is a massive premium over their target. And, well, to put that into perspective for you, return on equity is essentially the ultimate litmus test for management.
How so?
It measures how effectively they are taking the shareholders' capital and turning it into actual tangible profit. In the tech sector, where you have software with near zero marginal costs, you might see wild ROE swings.
Oh, sure.
But commercial property and casualty insurance is a mature, incredibly capital-intensive industry. A 21.2% return requires almost surgical precision.
It's funny, while I was digesting that number, I kept looking at their company logo on the report.
The little B.
Yeah, it's this understated green lowercase b, and tucked right inside the loop of the B is a little drawing of a wise old owl. W.R. Berkley really strikes me as that quiet, studious kid in the back of the classroom. Like, they never make a big fuss. They just diligently do their homework every single night.
And then the test comes.
Exactly. The teacher hands back the final exam, and not only did this kid ace it, they completely broke the grading curve for everyone else in the room. That is what dropping a 21.2% ROE feels like.
I love that analogy. And that studious persistence is exactly what generates these numbers. I mean, you don't stumble into a 21% return by getting lucky with the weather.
Right.
Or just hoping the market goes your way. It stems from a highly disciplined, two-pronged business model. So to understand the outperformance, we really have to look at the machinery generating it.
The fundamental engine of an insurance company operates on two completely different fronts: You're underwriting the policies, and you're investing the cash.
Let's start with the underwriting side.
Yeah, let's break that down.
Yeah.
In Q1 2026, the company wrote $3.78 billion in gross premiums.
But in insurance, top-line revenue can be dangerously misleading.
Oh, totally.
Yeah.
Writing $1 billion in premiums is a disaster if you end up paying out $1.5 billion in claims.
Exactly.
And that brings us to a metric they cite heavily in the report, which is the combined ratio. So for anyone needing a quick refresher, the combined ratio is essentially the ultimate scorecard for an insurer's core operations.
It measures the cash flowing out against the premiums flowing in.
Right. The claims they pay and the operating expenses. If your combined ratio is exactly 100%, you are just breaking even. You spent every single dollar you took in.
And if it goes over 100%, you are bleeding money on your core business.
Which happens a lot, right?
Yeah, historically, it is not uncommon for insurers to operate at or even slightly above 100%.
Wow.
They basically rely entirely on their investments to actually turn a profit.
But W.R. Berkley reported an accident year combined ratio before catastrophe losses of 88.3%.
That is fantastic.
So for every dollar they collect in premium, they're only spending about 88 cents on claims and keeping the lights on. They are pocketing nearly 12 cents of pure underwriting profit before they even start putting that money into the market.
What's fascinating here is the specific mechanism of how they protected that margin. Management explicitly states in the report that they are only growing their business where pricing, terms, and conditions support attractive risk-adjusted returns.
Meaning they aren't just taking any client that walks through the door.
Exactly. They achieved a 7.2% average rate increase across their lines if you exclude workers' compensation.
Which is wild, because demanding a 7.2% price hike in a highly competitive market is incredibly difficult.
It really is.
I feel like most businesses would be completely terrified of losing their entire client base to a cheaper competitor.
But that is the defining characteristic of their underwriting discipline. They have the internal fortitude to just walk away from bad business. If a sector becomes too risky, or if competitors are underpricing policies just to grab market share, W.R. Berkley will simply let that business go. They are not chasing volume. They are chasing margin.
And they leverage their deep, specialized knowledge of commercial risks to justify that 7.2% increase.
Yeah, their clients are willing to pay a premium because they know the company is financially stable enough to actually pay out a catastrophic claim if the worst happens.
And that disciplined underwriting generates a massive river of cash. Which brings us to the second engine of the business model, investing.
Float.
Yes, the float. Because when an insurance company collects billions of dollars in premiums, they do not just lock it in a vault and wait to see if a warehouse catches fire.
No, they put that money to work.
This is the legendary concept of float that basically built Warren Buffett's empire. It's money you hold and can invest, but that doesn't actually belong to you yet.
And the scale of W.R. Berkley's float is a strategic weapon. Their total net invested assets are sitting at a colossal $33.4 billion.
Just a huge number.
Right. And in this quarter alone, their net investment income grew by 12.2%. It reached a record $404.3 million. That investment income is a massive driver, pushing their ROE up to that 21.2% mark.
I want to push back on their investment strategy, though, or at least play devil's advocate for a second.
Okay, let's hear it.
When I dug into the breakdown of how they're deploying that $33.4 billion, it seemed surprisingly conservative to me. Over 76% of their portfolio is parked in fixed maturity securities. We're talking heavily about corporate bonds and mortgage-backed securities. And the average credit rating across that entire portfolio is AA. That is a phenomenally high-quality, low-risk rating.
It is essentially a fortress balance sheet.
Furthermore, the average duration of those investments is only 3.1 years. They're keeping their money tied up for very short periods.
Yeah.
So here's my question. If you are a sophisticated financial institution holding $33 billion, is a 3.1-year duration playing it far too safe? In a world where they clearly know how to generate excess capital, aren't they leaving a fortune on the table by not reaching for higher yields with longer durations or leaning into slightly riskier asset classes?
It is a really tempting thought, and chasing yield has historically been the downfall of many lesser insurance companies. But they are doing exactly what the architecture of their business demands.
Really?
Yes, you have to remember the fundamental nature of the float. That $33.4 billion is a liability as much as it is an asset. It is a reserve pool meant to pay for claims that could theoretically be filed tomorrow morning.
So absolute liquidity is the non-negotiable priority.
Liquidity and capital preservation, exactly. An insurance company is uniquely positioned because it is already taking massive, unpredictable risks on the underwriting side of the house.
Oh, that makes sense.
They are insuring against hurricanes, complex liability lawsuits, and major supply chain disruptions. You simply cannot afford to run a high-risk operation on both sides of your balance sheet.
So the investment portfolio has to act as the anchor.
Yes, a 3.1-year duration is highly strategic. It means they have very low exposure to interest rate volatility. Think about it. If macro interest rates suddenly spike, the value of a 10-year bond plummets.
Right.
But with a 3.1-year duration, their bonds mature quickly. That allows them to take that cash and immediately reinvest it at the new, higher interest rates. The conservative nature of their AA-rated investments is precisely what buys them the freedom to be aggressive and underwrite $3.78 billion in complex commercial risks.
They build an impenetrable bunker on the investment side so they can confidently walk out into the storm on the underwriting side.
That's a great way to put it.
And speaking of the storm, we have to look at the real-world volatilities they are insuring against. Because the report notes that for Q1, catastrophe losses actually dropped.
I did.
They took a $75.6 million hit from catastrophes, which is a significant decrease from the $111.1 million they absorbed in the first quarter of 2025.
So it was a relatively favorable quarter in terms of immediate weather events. But the backward-looking numbers are only half the story.
Oh, absolutely. The section of the report that felt the most visceral to me was the forward-looking safe harbor statement. Normally, risk disclosures are just, pages of boilerplate legal jargon designed to protect executives from lawsuits.
Yeah.
But reading W.R. Berkley's specific list of macro risks feels like reading a diagnostic report on the anxieties of the modern world.
It's intense.
They explicitly point to climate-related risks altering the frequency and severity of natural catastrophes. They cite the ongoing conflict with Iran. They mention the lingering threat of pandemic.
And inflation, interest rate shifts, global trade tariffs.
If we connect this to the bigger picture, this list is far more than just legal cover. It is the tangible, physical reality in which they have to price their products. Property and casualty insurance acts as the ultimate shock absorber for the global economy.
Exactly. When inflation spikes, it isn't just a number on a screen. It means the cost of lumber, steel, and labor skyrockets. Consequently, W.R. Berkley has to pay significantly more to rebuild a client's destroyed facility. When geopolitical tensions with Iran threaten global shipping lanes, marine and cargo insurance risks multiply overnight. They are literally in the business of putting a precise, profitable price tag on global chaos.
The way they have to synthesize all those moving parts is daunting, but there was one highly specific, incredibly modern risk they cited that just completely captivated me.
I think I know which one you mean.
The report states, and I'm quoting directly here, the increasing use of artificial intelligence technologies by us, or third parties on which we rely, could expose us to technological, security, legal, and other risks.
Yeah, the AI risk.
How does an underwriter even begin to build a model for that?
It represents a fundamental paradigm shift in risk assessment.
Because, if you were underwriting a fleet of commercial delivery trucks, you have a century of hard data. You know the exact correlation between driver fatigue, weather conditions, brake wear, and accident frequency.
Actuaries can predict with terrifying accuracy how many of those trucks will crash in a given year.
But artificial intelligence operates entirely outside of historical precedent.
Yeah.
How do you accurately price a commercial liability policy for a tech firm when the AI model they deploy on a Tuesday might invent a completely unprecedented way to trigger a massive copyright infringement lawsuit by Thursday?
Or hallucinate secure data. The historical data simply does not exist. Traditional underwriting looks backward to predict the future.
Right.
With emergent exponential risks like AI, looking backward tells you almost nothing. They are forced to rely on theoretical modeling, extreme stress testing, and scenario planning.
That sounds incredibly difficult.
It is, and this is exactly why that earlier conversation about their 88.3% combined ratio and their 7.2% rate increase is so critical.
Oh, I see.
When you are writing policies in an environment where an AI hallucination or a sudden global pandemic could trigger a wave of unprecedented claims, you cannot price your products for perfection. You have to build a massive margin of safety into your premiums to cover the unknown unknowns.
Okay, so we have this holding company successfully navigating climate risks, geopolitical conflict, inflation, and the rise of AI. They price these risks with ruthless discipline. They invest the resulting float with an ironclad focus on capital preservation, and they generate massive, record-breaking profits. What happens to all that excess capital?
Well, it translates directly into shareholder value.
The payoff for Q1 2026 was immense. They returned a total of $336.1 million to their shareholders in just 3 months.
Which is incredible.
And how they structured that return is really telling. They paid out $33.7 million in traditional regular dividends. But the overwhelming majority of that capital, $302.4 million, was deployed to repurchase nearly 4.5 million shares of their own common stock.
That's a huge buyback.
So what does this all mean? Like, why would a company spend over $300 million buying back its own stock instead of just writing a massive dividend check to everyone holding a share?
Share repurchases are one of the most powerful tools management has to signal their belief in the intrinsic value of the business.
The mechanics of it are actually brilliant. Think of a publicly traded company like a private business partnership. Or, even simpler, think of it like a pizza.
Okay, a pizza.
Imagine you and 4 other people own a highly profitable business together. You each own 20%. One day, the business has generated so much excess cash that the management says, hey, we want to use this cash to buy out one of the partners who wants to leave.
Right.
So the business pays them off, they exit, and their ownership stake is retired. The business itself hasn't changed. It is still generating the same massive profits. But now, instead of the profits being split 5 ways, they're split 4 ways.
Without you having to invest a single extra dime.
Exactly. Without lifting a finger, your ownership stake instantly jumps from 20% to 25%. That is exactly what W.R. Berkley is doing on a massive scale. They are taking 4.5 million shares completely out of circulation, structurally consolidating the equity, and driving up the underlying value of every single share left in your portfolio.
It is a phenomenal way to visualize the mechanism, and the report explicitly reinforces the intent behind this. Management stated that their balance sheet remains a, quote, source of strength.
Yeah.
When a company aggressively buys back its own stock, it is broadcasting a very clear message to the market. They are declaring that they have more than enough capital to safely cover their underwriting risks, and they believe the absolute best investment they can make with the surplus is in themselves.
Wow.
It is a tangible demonstration of their confidence that they will continue to crush that 15% ROE target moving forward.
They are essentially placing a $300 million bet on the wise old owl.
And based on the Q1 data, that looks like a highly asymmetric, deeply favorable bet.
It is genuinely remarkable. I mean, we started this journey fighting through a Cloudflare bot check just to get the data, and we ended up dissecting an absolute masterclass in corporate strategy.
We really did.
We have uncovered how W.R. Berkley leverages ruthless underwriting discipline, having the courage to demand a 7.2% rate increase, and the wisdom to walk away from bad risks, to maintain an 88.3% combined ratio.
And we've seen how they pair that aggressive underwriting with a highly conservative AA-rated investment portfolio.
Right, keeping their duration short so they can weather macroeconomic storms.
The overarching takeaway here extends far beyond analyzing an insurance stock. W.R. Berkley's strategy provides a robust framework for personal decision-making.
How so?
It is about understanding the dual engines of your own life. You need a conservative, highly liquid foundation, your personal float, so that you can afford to take calculated, aggressive risks in your career trajectory or your entrepreneurial ventures.
That makes a lot of sense.
It is a lesson in structural resilience. Build the bunker first, and then you can confidently navigate the volatility.
You secure the downside so the upside can take care of itself. But, as we wrap up today's deep dive, my mind just keeps drifting back to that safe harbor statement, the risks they are actively tracking.
The AI risk. This
Yeah.
raises an important question. If the increasing deployment of artificial intelligence presents technological, security, and legal liabilities so complex and severe that giant insurers like W.R. Berkley are explicitly flagging them in quarterly earnings reports, who really controls the pace of this technological revolution?
That is the big question.
We inherently assume that the tech innovators and the venture capitalists will dictate the speed limit. But if the risk becomes too unpredictable, the ultimate braking mechanism might be the insurance industry.
Wow.
Actuaries will look at the data, realize the potential for catastrophic liability, and simply decide the risk is too great to underwrite. And if the tech giant cannot secure a liability policy for their groundbreaking new AI model, can they actually afford to deploy it?
Man, it is a profound thought to leave you with. Take a moment this week to examine your own risk portfolio. Are your investments, your career moves, and your daily habits structured to yield the returns you actually want?
And if they aren't, it might be time to channel your inner actuary.
It's exactly. Walk away from the bad risks and adjust your premiums. Thank you for joining us on this deep dive. We will see you next time.